Welcome to the weekly update, where I'll go over the action in the market for the week of December 30th through January 3rd, and we'll see how things look for the week of January 6th through the 10th. Please be reminded that on Thursday, January 9th, the stock market will be closed for a state funeral in honor of President Carter. And so everything will be closed that day as far as the stock market is concerned. Okay, before I get into the video, just a few points to bring to your attention. This is a weekly video, but I also do a video each day. And we're going through some changes right now, and these changes are kind of subtle, but I go over them in the daily videos, and they're available on YouTube and Rumble. So feel free to check those out. They are delayed. Members get access to the videos right when they're available, but I delay them being available to everybody, but I provide a lot of commentary and analysis. Below every video that I post on YouTube or Rumble, there is a PDF where you can download the slides. You can see the words here. You can see the charts that I use in that particular video. I also update pivot points every day on the YouTube community tab. I can't do this on Rumble. And because we switched over to January, there are new pivot points on the daily chart that will be good through the whole month. Then there are intraday pivot points that I update every day as well. I do have a private Facebook group. You're welcome to join that if you belong to Facebook. And I've been seeing the social media experts coming out of the woodwork again, so I've been having to go through and delete some of those comments. I don't get those on YouTube, but I do get them on Rumble. And I do post on Rumble. Here is a link to that. And I use it as a backup. If you can't find me on one platform and you think the video should be there, go to the other platform to check that out. Okay, so for the week, we were down 0.48%. Santa Claus just didn't show up for the Santa Claus rally, which goes back to Christmas Eve. We were below average with volume. Not a real surprise there because of the holidays. We are negative on the daily side in the short and intermediate term, and the 50-day moving average on the daily charts for a number of days now has provided overhead resistance. And even though we were up on Friday, we've not been able to get back above that 50-period moving average. Now, I also use a 20-period moving average. That's what I use to measure the short term. We're below that, so we're negative in the short term on the daily side. We're negative still in the intermediate term on the daily side until we can get back above that 50-period moving average. We saw some improvement on Friday, but it really just worked off kind of an extreme down situation or oversold condition that the market may be going through. We're seeing some weakness here in the weekly charts, but there's also some signs of strength. But one thing that I'll talk about here in just a moment, what's pressuring stocks right now is, first of all, we had back-to-back really good years, and people think there's no way that can happen. Then you have the other side of the crowd that says, what? We had 2 good years? Well, naturally, the third year will be good too. But we're wondering if the economy is starting to shift. A new administration is getting ready to come in. There's going to be some big changes. So the market's a little uncertain about that, and interest rates have been going back up, and that has been pressuring stocks. We're at 4.6% now. When we get above that 4.5% level, that's when stocks really start to notice that. We actually came down a little bit this last week, but we're still above that 4.5% level. There's all kinds of crazy things going on geopolitically, but the market just doesn't seem to care about that. We're going to get the FOMC meeting minutes this upcoming week. So that might give the market something to key off of. And then this is a change here. We're not trending now. We've dropped below 20 on the weekly chart. We just started new trends on the daily side in the short and intermediate term, and they're negative. So we're in more of a negative environment here when we look at the trend, and I'll show you this chart. The green line has dropped below the red line, and we haven't seen that for quite some time. Yes, Santa Claus didn't show up this year. Sorry about that. Okay, so just some bullet points. We had a mixed week. Small caps ended up rising, but they're really going nowhere. They're just kind of bouncing around in a range. They're not taking off to the moon the way a lot of people had anticipated, but they did outperform. So going back and looking at the year, we were up 23.3% with the S&P. Pretty stinking good. And the Nasdaq was up even better at 28.6. Doesn't mean there are not bumps along the way, but by the time we got done with the year, it was pretty positive. And we were down 0.5% for that whole Santa Claus rally period. And as I mentioned before, on the daily charts, and if you watch something during the week and you only watch this video, keep an eye on that 50-day moving average if you have charting capabilities. If not, feel free. I'll be going over this like crazy in the daily videos, and it's acting as resistance since we're below that. And volume was below average because we had this thing called Christmas. And then a week later, we have another thing called New Year's, and people like to take time away. Now, it's expected that this week volume should pick back up. Now, the market's going to be closed on Thursday, but a lot of folks are done with their vacations, done with the holiday season, and now we'll at least expect volume to pick up. We'll see if it actually does that or not. Interest rates actually fell. A week ago, we were at 4.64%, and that's high. We're at 4.6%, which is still high and still has the market concerned. Now, we actually ticked up a little bit with interest rates in Friday's session, but the stocks wanted to go up anyway. And the dollar, that's also been pressuring stocks. It got up into the 109 range after Thursday. Now it's back down into the 108 range, and it's been pretty strong compared to other currencies in the world. Okay, so the Dow was down 0.6%, the Nasdaq down 0.5%, the S&P down about 0.5%, and small caps, which really got a lot of that gain in Friday's session, they were up 1.1%. This is a chart that I've been showing for quite some time. We're wondering where we're at with this dark blue line here. This is inflation coming down. And this is what some folks are concerned about. They're afraid that we're going to enter into some kind of a situation where inflation is really going to go back up. We don't know that. We'll keep an eye on things, and I watch these things very closely, and we'll just see. There's a lot of different charts that I look at. I post supplemental videos on the website that I have. You're more than welcome to check that out, and we'll just see how it comes. Okay, so we're at 4.6%, which is still above the 4.02% level. That's where it starts really digging into corporate profits. And we're seeing corporate profits being revised down. Now, some of that could be a game that is played. I'll explain that again in a minute. This has not been updated. After next week, the upcoming week, I should say, this chart will be updated again. We're going to get the employment situation report in Friday's session, and that is really big. And then this chart will be updated after that. Okay, so when you look out into the future, we're still going up and to the right as far as earnings estimates. They're coming down, but they're still going up for the most part. And that justifies stock prices going higher. Okay, the longer the holding period, the more likely to see gains. And yeah, about 70% of the time over the last 100 plus years, over 100 years, we go up about 70% of the time. But that 30% can be really scary and really it's what the perma bears live for, that 30%, realizing that they're going to be wrong 70% of the time, but they're predicting it 100% of the time that we're going to be going down. And that's just goes well into the idea of buy and hold. Now, I have long-term investments, but to limit these downtimes, I implement hedging that I teach in the program that I have, and I update that in videos that I post there every day. If that's of interest to you, feel free to check that out. Also, we did get the ISM Manufacturing Index. We compare that to the S&P 500, where we've been coming down with the purple line. We've been coming up again here with the gold line, and that's actually showing an improvement. But you can see if you go back over time, these tend to not get all that far apart from each other, and they tend to go in the same direction. We've been seeing a disconnect between the two. Are these starting to line up more with each other? Does that mean the S&P is going to keep coming down and ISM is going to go up? Or are we going to turn and go up with the S&P, and then we're going to see continued strength with the ISM manufacturing? We don't know what will happen there, but this has been out of line now for a while, and we'll wait to see if this gets more in tandem with each other. Also, the PE ratio, the top 10 and remaining stocks, it's if you watch Gilligan's Island, the rest, there, the professor and Marianne, where it's really we have the Magnificent Seven, the Great Eight, the Illustrious 11, whatever you want to call them. They're very overvalued. They have a PE ratio of 29.8. And I'll be going over this same chart again in the intermarket analysis video where I do a valuation breakdown of the S&P. But at least up to this point, folks haven't really cared. Now, the average is 20.6. So this would consider that we're way, way expensive right now. And then the remaining stocks, they're at 18.2, where the average is 15.7. Around 15, that's when we consider stocks to be fairly priced. They get overpriced when we go above 20. Based on that theory, we could still go up a little bit with the other stocks in the S&P and not be necessarily overvalued. Where we're looking at being over 20 when you take the S&P as a whole, 21.5, the average is 16.6. And so no matter how you look at it down here, we are overvalued. And I've been seeing the same thing for years now when I do the intermarket analysis video. But the market can stay that way for a long time. It doesn't mean, oh my gosh, we're overvalued, get out. No, we look at other technical things to determine when to do things like that. Now, we are turning more negative right now. We're still positive in the long term on the daily charts, but we just keep a close eye on things here. Equity risk premium is low, and you can see other times when we were getting really high up here before, and then it was coming down. This is when we were in the great financial crisis, and then we had a real severe drop back in 2011. Then you had the whole COVID thing that happened. Well, we're getting back up here. Expensiveness. I guess I didn't even know that was a word. But this is relative to the 10-year bond. If you have a chunk of money, do you want to put it in something considered risk-free or virtually risk-less, like a 10-year bond backed by the US government, or take that same amount of money and put it into the stock market? And that's what this is trying to measure right now. Okay, then the real 10-year total returns. Real means it's taking inflation into account. This is the spread between the S&P 500 and treasuries. And when this is going up, that means stocks are outperforming, which they have been doing for quite some time. And then exuberant returns, where we were looking at possibly 6 down days in a row, which doesn't happen very often with the S&P. And we bounced up out of that in Friday's session. But we did have 5 down days back to back there. To what extent do you think the Magnificent Seven stocks, how much are they going to go up? And a lot of people are right around anywhere from 0 to 10%. That's good. Okay, but you still see a lot of folks, and the light blue, this is what people were thinking just a few weeks ago. And they've really come down with the average at about 6.8%. We'll have to see if the market's able to exceed that or even meet that. All right, then FactSet had one blog post on Friday, and this is just showing that what I talked about a few moments ago, negative earnings per share guidance, because we're getting set to start coming into earnings season now. And so we're seeing an increase in saying a company comes out and says, well, you know that earnings, we better push it down a little bit there. And that can be pressuring stocks a little bit too. That's more the reality of things. The game behind it is that sometimes they like to lowball the earnings. So then when they finally come out with their earnings report, it's like, oh, they beat estimates. Oh, and the stock may get a nice little pop out of that, and everybody's happy, and it's like New Year's Eve all over again. So there's a couple of different ways to look at this. So we're seeing an increase in the negative guidance and a decrease in the positive guidance as we get set to go into this next earnings season. All right, so here's the intraday chart. We gapped lower right on Monday. Not a good way to start the week, but this was looking positive. We hit a low here, and we were able to bounce up out of that, but then kind of finish flat for the session. And it looked like, okay, maybe there's something positive developing. No, we didn't see really any carry through into Tuesday. We just kind of chopped lower. And the market was open all day on New Year's Eve, unlike Christmas Eve where it closes early, but volume was very light. And then everybody thought, well, it's the first trading day of the new year, and we're automatically going to go up. We did gap higher, came down, tried to go up, came down, bounced around a little bit. And then after the open gets finished, Then the smart money comes in and they decided to do some selling. But we did find some support here and we bounced up going into the close on Thursday, which did feed over into Friday. So this is positive to see this coming back up in Thursday's session and then carry through in Friday's session. We got up right around the 50-day moving average is at 59.44. We actually got a little bit above that, but we could not clear 59.50 and then we closed down just a little bit below the 50-day moving average. Okay, so now these are kind of misleading, especially the year to date. This is a weekly chart of how things were doing, but I don't do it compared to the S&P. I'm just looking at these indexes all by themselves, where the small caps ended up being the most positive. And this is just the 4 trading days. This isn't Friday to Friday the way a lot of these charts work. But looking at it this way, we were up with the Dow being up the least. This is the one that's misleading because even though there were 4 trading days, we've only had 2 trading days. So year to date, yeah, everything's looking really good here. This is pretty much all Friday happening, and this will start to even out as we go through the year. The sectors, we had a down week really from Friday to Friday. And so I organized this by what was down the most. Materials, they've been getting hit pretty hard. You look over on the right-hand side, their sector score, their scooter score, it's 2.3, and that's on a scale of 0 to 100. So they're not looking very good these days. Discretionary saw a nice little bounce, has been doing very well since last August when we had the end of the world day that lasted a day or so. And you can see over here, this is a strong area, 96.2. And then we had staples were down. That's more defensive, but they're dealing with their 50-day moving average on the daily charts. Are we going to get a bounce from that? If staples start to go back up, does that mean the market's turning more defensive, getting ready to go down? Tech ended up being down. And energy, which has just been getting hammered. Now that interest rates are going up, the Fed has come out and said, we're a little bit concerned about inflation going out into the future. So we saw a bit of a bounce with the energy sector and with utilities as well. Then looking at just the scooter scores and ranking them from highest to lowest, where discretionary is looking the best. Then we have financials. They're still dealing with their 50-day moving average, but they're looking pretty solid. And communication, discretionary communication and tech, which is kind of lagging right now at 57.6. Those are the three big growth areas, and we need those to do really well to help the indexes go higher. All right, so looking at the sectors where energy was up the most, this is just the 4 trading days. And we had materials, discretionary, and staples. Even though discretionary did okay on Friday, they'd been getting hit hard before that. And then year to date, again, there's only 2 days here, so it's almost like why waste our time? And then looking at the relative rotation graph, this still goes back a year. And this looks at the different sectors where we still have tech doing the best over the last year. Communication and financials, those are three good areas. We would also like to see the discretionary area doing better than it has been doing. Oh, this is discretionary. I'm sorry. Tech is over here. It's actually lagging a little bit, but showing some improvement. And some of the more defensive areas are what have been getting a little bit weaker lately. And then here's the spreadsheet look. Communication, financial, discretionary are looking more positive. Industrials are more neutral. And then utilities, staples, real estate, materials, healthcare, more the defensive areas. They've been weaker lately. We'll be watching those to see if they come on strong, if the market still continues to be under pressure. And then what's showing some improvement is the tech sector, and then energy had a really good week. This is going over the last year. This looks like a spaghetti jumbled mess right here. The only thing that's really been coming down are utilities. They were very strong through much of 2024. They've really been pulling back lately. And now the market's trying to figure out, okay, what do we want to do? We still have the NASDAQ 100 doing good and the S&P 100 looking a little bit better. They're still holding up. The large caps have been hanging in there fairly well, even through this negative time that we've been through. Here's the spreadsheet look with the S&P 100 and NASDAQ 100. The S&P 500 still under some pressure. The composite, which is the Dow that transports utilities together. Utilities have been under pressure, and we're seeing some improvement, but again, most of it came on Friday. But this is over the last year with the small caps, the transports, and the mid caps. These are the areas that folks have really been anticipating doing better we'll have to see. They really haven't started going up very much, at least yet. Sentiment, we finally got a reading from Investors Intelligence. They're coming down. We're still over this 3 level, but the context is that this is declining. And the people that put out newsletters and make recommendations, they're coming off of a pretty extreme reading. And we almost got down below 25. We were at 26 after Thursday. We didn't quite get into this extreme fear area. That's when we start looking at using sentiment in a contrarian manner. If everybody's negative, we're looking for the market to go back up. Well, we did bounce up on Friday. So we went from 26 back up to 32. And then looking at the chart, where we didn't quite get down to 25, but we are showing a little bit of an improvement. Now we're going to have to see more follow through with this, and we're still below 50. So it's improving, but still negative. Okay, and you're going to hear a lot of that with the charts right now. The active asset managers coming off of their extreme positive reading, they're getting a little more neutral right now, coming in at 64.1. And we saw a little bit of a tick up on a weekly basis with the VIX, but we're still under 20. That's the positive side. The negative side is we're getting a lot higher readings than one we had been getting throughout most of 2024, both with the line chart and the bar chart down below. This is still positive for right now. When this black line is going down, that means the tech sector is outperforming 1 to 3 month T-bills, which you could pretty much call cash. If this black line really starts to go up, then we're going to get more concerned. The right X bear bull ratio is still quite bullish on things right now. Getting a very low reading, that means most folks are into the bullish funds instead of the bearish funds. Coming down to about neutral with the American Association of Individual Investors, and you'll notice the 50-week moving average is starting to roll over. They've been pretty positive for quite some time now. Now, these are individuals, and they're not considered to be the smart money, but we'll have to see. I mean, the sentiment that they have can really help push the market one way or the other. And by them, I mean us, because that's what we are. All right, then the Ulcer Index on the daily chart, we're still above the moving average. We're still below the moving average here on the weekly chart. Keeping a little eye on this. We're seeing a little bit of a tick up when we look at the spread between risky and not as risky bonds. Now, the next chart is an inversion of the chart we just saw, where when this is coming down, that means fear is increasing. We did tick up just a little bit in Friday's session, but if this continues to fall, that means fear is going up, and that could be a problem for the market. And we're ticking back up here when we look at the VIX versus the 3 month average of the VIX, and then doing a ratio where we had been declining. Since the election, the VIX has been giving us higher readings, and that's why we're seeing this going back up. But we're still going down with the long term, and this is 253 days because that's how many trading days there are in a year. This is the equity put call ratio. It's continuing to go down, and that is positive. I also have a 5-day and a 10-day chart that I go through in the daily videos. Still looking okay here economically with the financial conditions index. We're still under the black line. And I thought this came down a little bit here. This is the latest reading from GDP Now, a little bit over 3%, where the consensus out there is about 2.5 to the upside, 1.5 to the downside. And still coming in here, dropping down a little bit with the forecast with GDP, but still positive. We'll be watching this. This has not been updated yet. It'll be updated next week after the employment report comes out. This has been updated. We're coming above the black line here. Now, if we go all the way up to the red line, that's when we're probably in a recession at that point. So we are seeing an increase in fear of recession probabilities. This was updated, but this is a quarterly chart. This is supposed to be a leading index, but by the time we get the data, it's like a long time in the future. Coming down a little bit here with the worries about going into a recession. Inflation, starting a new year, starting a new quarter, not much to see here. All right, there's an 89.3% chance the Fed is going to leave rates unchanged. They've pretty much come out and said they're going to do that. So the market's pretty much locked into that. And that's what we've been seeing lately here. And then the next meeting is March 19th. 51% chance that rates will be the same, 43.7% chance that they'll be lowered, 0.25%. And this will adjust a lot as we get closer to that meeting. This is just a look at the Fed balance sheet, where for the most part it's been going down as the Fed said it would. This is the year over year change where it's actually going up a little bit here. Now we're coming up here with the overnight reverse repurchase agreements, and there's something weird going on. We'll have to see what's happening. This had been kind of declining, really kind of tame, but with this spiking up, we're just going to keep an eye on the financial sector and the banks as well. All right, so we're still positive with the advanced decline line weekly chart. We're also positive on the daily chart, but we've been coming down. We're still above the moving averages based on price and volume, both on the daily chart and here on the weekly chart. This is where we're seeing some weakness, though. We're seeing an expansion of the new lows and a contraction of the new highs, both on the daily side and here on the weekly side. So we're going down with the 5 week and the 10 week. I have a 4 week here. I have a 5 day and a 10 day moving average. Those are also declining on the daily charts. Now, we're barely positive on the daily side with accumulation distribution, but we're still positive here, even though we've been coming down a little closer to the moving average. We ticked up a little bit and we're still above zero with our 19-week and 39-week advanced decline ratio. So this is still positive. This is where we're turning more negative. We have the black line, which is the ADX, going down and dropping below 20. That means we're not trending right now. Also, we're seeing the red line crossing above the green line. Is the market getting ready to switch over and be more negative? We don't know that. We'll just evaluate it on a day-by-day basis, watch the daily videos, and check out the program that I have. I keep real close. This is what I do, and I keep real close tabs on these things. All right, we're still positive with the Arun, where we're negative on the daily chart. Mass index is not generating a signal right now. Here is the daily chart, and it's a little easier to see now because we have the pivot points set up for January and they pushed off to the side. We're having a really difficult time getting back above the 50-day moving average. We sliced through it pretty quickly, and now it's been acting as overhead resistance. And you can see down on the bottom, the last number of days have been well below average with volume. So when we look at the daily side of things, we're negative in the short term with stocks. Bonds are negative in the short, intermediate, and long term. Commodities are positive in the short and intermediate term. The dollar has been really strong on all time frames. And we're negative in the short term with stocks. We're also negative in the intermediate term with the mid caps. And there's been no change here. We're negative in the short term with the decision point scorecard. We're also negative in the intermediate term with the PMO, the price momentum oscillator. This is what I'm thinking might be part of the problem. We have a trend channel going back to 2009. We got above it in 2021, only to go into 2022. We hit the upper end of this channel again, and that's when we hit the high with the S&P, and we've been having some trouble since that time. Then we have new pivot points. Now, these will last for the whole quarter. These are long-term, and they can be very significant. So we're not near one right now, but I look at this every day, and we'll see if things change that way. We're still positive, even though we're pulling back with the weekly chart. We're still above the 50-week moving average. So we're still positive here. We're having a little bit of trouble around the 13-week moving average, and there's another 10-week moving average that I'll show you here in a moment. But can this hold up? Now, we're still positive longer term since the blue line is above the red line, but we're seeing some more shorter term weakness here. But if you go back to the end of 2021, we were looking really positive there. And then we started to break down. And then it was, my goodness, into April before we actually crossed negative here. We're just watching this, not predicting anything. We let the market tell us what it's actually doing. And we're negative in the short and intermediate term, but we're still positive in the long term on the daily side. We're just going to be watching this. All right. And we did bounce up a little bit with the McClellan oscillator, but we're still below zero. So we're continuing to decline with the summation index based on price and volume. That's a little longer term negative. Not much of an improvement with the bullish percent index. We've been going down. We saw a little bit of a bounce in Friday's session, but we're below 50. That's more negative. We're below zero and declining with the Swenlin trading oscillator. We're also negative on the daily chart. And momentum is negative across the board on the daily charts. We're starting to roll over here on the weekly chart, both based on price and volume. But when we look at the PMO studies, we're showing a bit of an improvement with the PMOs that are rising. The buy signals are still extreme negative, but starting to bounce up, but we're still going down with the PMOs that are above zero. And we're still above the midpoint here with the Bollinger Bands. That's still hanging on to being positive longer term, where we're dropping below the midpoint when we look at the daily chart. And we're still looking positive here longer term, but we're rolling over a bit with the Chaikin money flow. Now we're negative even after Friday. The Chaikin money flow still went down, even with the bounce that we saw in Friday's session. And we're negative across the board with momentum. We're turning more negative here. Longer term, we're starting to roll over with the momentum. And we're turning back a little bit more positive with the Chaikin oscillator on the daily chart, and we ticked up just a little bit, but we're still below the moving average here. However, we're still above zero with this indicator. We're above 50 and going up with the money flow, where we're negative on the daily side. The force index is barely positive on the daily side and barely negative here on the weekly side. We had a down week, so our rate of change from one week to the next is down. We're coming down, getting back down to this red line here when we go back 50 weeks with the rate of change. We're still extreme negative with the Stochc RSI. Now, we could stay here for a while, especially if we turn more negative. This could also suggest that things are oversold right now and could be due for a bounce. Williams percent are, after being extreme positive for a lot, in fact, most of 2024, is now starting to come down, but it's still above the midpoint. We're still above 50 with the RSI based on 14 weeks. Coming down, but still positive with the vortex, where we're negative on the daily side. We're negative with the ultimate oscillator, where we're still positive here on the weekly side. We're negative with the Copic curve on the daily chart. We're also negative here on the weekly chart. And we're positive longer term with the special K. The weekly chart is positive. The daily chart is positive. This is the other moving average I was talking about. The blue line is a 10-week moving average instead of the 13 that I use with most of the other charts. We fell down below this. Now, this had provided some kind of support previously, but we've also fallen below it, been able to get back above it. We're going to be watching this, just like we're watching the 50-week moving average right now. Okay, so we're looking a little more negative with the Heikin Ashi. We see black candles. We're pointing down with the Kegi chart. That's also negative, but we're still positive with the Renko chart, and we're still positive with the three-line break. So we're seeing a bit of a mixed picture there. We also saw some circles drawn in here. That's negative with the point and figure chart. We saw those drawn in earlier in the week on the daily chart, and even with the bounce on Friday, no X's have been drawn in. And there's no signal or pattern that's being found here. We're declining, but still above zero with the ease of movement. And we're coming down with the long-term, intermediate term, and short-term when we look at momentum. 50-day cycle, okay. And we're still neutral, though, with the Elder's Impulse system for the S&P. This is the third week now we're negative on the weekly side. We switched back to positive on the daily side in Friday's session. Hold it. No, we're still negative. I'm sorry. I take that back. We are negative on the daily chart. We're negative here on the weekly chart. Trying to remember what I saw here. And just looking at the S&P, well off of its highs. The mid caps have just been going sideways. And even though the small caps had a good week, they just got to the upper end of the range that they've been in. We're still positive here. Now, another thing that we're watching so far on the daily charts, the NASDAQ 50-period moving average and NASDAQ 100 50-period moving average have been holding. We may be getting some support from that if we're getting set to go higher. And we're coming down here and we're still above the blue line where we're below the 50-day moving average on the daily chart. This is still holding up for right now. And you can see that we've so far been holding up above this with the NASDAQ 100. So we'll be watching this as well. And this actually shows that we had a little bit of an up week. Usually it's a red candle when we have a down week. All right, the Dow falling below its 13-week moving average, showing some weakness there. Mid caps also below its 13-week moving average, but still in an uptrend. Small caps, again, not really going anywhere, at least yet. This is a daily chart of the Wilshire. See how we're coming up to the 50-day moving average and hitting that? We need to clear this for things to turn back more positive. If this cannot get above it, that could produce some more problems for the market. NYSE actually showing a little bit more strength. The McClellan oscillator on the daily charts, it's still negative for the S&P. It's switched back to positive positive for the NYSE, and we're still showing some weakness here on the weekly side. So there might be some under the surface strength, but we're not seeing it yet based on price. All stocks coming down and falling a little bit below their 13-week moving average. The FANG index, these are the big stocks. They've been holding up better, still have a ways to go to get down to their 13-week moving average. ARC was up 0.93% and still in a longer-term uptrend. Keeping an eye on the banks. Now, we've seen some pullbacks here. We're turning negative with momentum, but we're still above 50 with the RSI. And then just looking at the Dow, where it's off of its all-time highs, the transports have been going sideways. The utilities have been quite weak, even though they bounced up a little bit this past week. Now we're coming into January, and this only goes back the last 5 years. So it's back to 2021, and we're up 60% of the time with a 0.5% return on average over the last 5 years. Okay, the broad market. We look at commodities. They are in an uptrend still on the weekly chart. Oil's been starting to go back up. There's some crazy geopolitical things going on that oil might be reacting to some of that. Gold is still underneath its 13-week moving average, but in an uptrend, and we came down to the 50-week moving average with silver. Is this going to provide some support? We're still in an uptrend here. Copper still in an uptrend, but just chopping all around now as it tries to decide what's going to happen with the economy. And the dollar's been really strong. As I said, we got up into the 109 range, but this is just a line chart, so it's not an open, high, low, close chart. We ended up closing down into the 108 range, excuse me. And looking at bonds here, we came down to the 50-week moving average. Will this hold? Are we going to be able to bounce back up? If this goes up, that means interest rates will be going down, and that could help stocks. If we break below this, that could be a lot more negative. But when you look at the monthly chart of the stock to bond ratio, stocks continue to outperform. This is how we've been going back up on the daily chart with the yields. And we'll be watching that. We're also watching internationally, keeping an eye on Japan now that we're above 1% here. What set everything in motion last summer with the big down day that we had, that started in Japan. And that was the carry trade where they could get yen for no interest at all. And then as interest rates were coming back up, the market was freaking out over that, and that produced a tidal wave that went throughout the whole world. Fortunately, it only lasted a few days. But with interest rates going back up in Japan, that puts that at risk still to happen. So I'll be watching that one. Then this goes, since we only had 2 trading days, I went ahead and just kept the recent intermarket analysis chart here. So as of 2 trading days into 2024, we still have gold doing the best, followed by stocks. Oil's been coming back up. The dollar's been doing good. Bonds are negative based on price. Okay, looking at some ratios. Now, this could be positive. S&P had a really good year. NASDAQ 100 had a good year. The NASDAQ 100 is now starting to outperform longer term. We've been going sideways lately. We'll have to see if this can continue to go up. That would be much more positive. The S&P 100, the biggest stocks that make up the S&P 500, show the big stocks are outperforming. Growth to value, this is encouraging. We're seeing this ratio longer term going up, and that's what we want to see in a more positive environment. Gold to the S&P still continues to pretty much chop sideways. Bonds continue to underperform stocks. Gold has been coming down lately as the dollar's been going up, so we're seeing this ratio continue to fall. And low volatility stocks. Now, look at the end of 2021. We saw them really surging, and then we went into 2022. Are we seeing that right now? No. So this actually is positive, at least something to hang on to. Energy bounced back up this past week, but it's still underperforming tech on a ratio basis. Discretionary, another growth area. This continues to be really strong, and that could be positive for the market as well. And small caps continue to underperform the tech sector, and it's a broken record there. Then longer term, we're not really getting much from this NYSE breadth thrust. What we are watching is for a ZWAG NYSE breadth thrust. Once we cross back above 0.4 after getting a very low reading, we need to get up to this red line, and we have 10 trading days to do it. Now, I haven't actually calculated the day because we've been so negative lately. If we continue to go up and we get closer to this red line, I will be calculating this. And I'm going over this in the daily video as well. And just to show you, when we get one of these, that's quite positive for the market. Longer term, we're still well above the trend line. This is a further blow up, also still above this trend line. Still on a full-on buy signal with the Zohorchak method. That's positive. The NASDAQ 100 weekly chart is still holding up quite well. The NASDAQ 100 to Dow ratio is going up. That's positive. And the NASDAQ 100 to small caps also going up for the most part, and that's positive as well. But we've been coming down. We're seeing some internal weakness in the S&P. The new highs minus the new lows, the 50-week moving average is continuing to decline, but we're still above zero. Also coming down with the NYSE highs minus the lows, and this is a 50-week moving average here, 50-day moving average here. And we're still going up with the cumulative new highs, new lows for the NASDAQ. And we're coming down here. We're just keeping an eye on the 3-month yield to see if anything weird happens. But we also watch this in conjunction with the banks and the financial sector. And then we have the Hindenburg Allman. And if you don't know what that is, this defines it right here. But Stock Charts puts all three of the criteria into a single indicator. We did get the confirmation. Now, this is supposed to be on the books for 30 days, so we'll see how that works. And I think it's after we get the confirmation. So that would put it around December 19th or so. The perma bears love this thing, and they just treat one of these spikes as an end of the world cry. We might see some more confirmation signals like we did at the end of 2021 or right before the COVID crash, and then at the end of 2021. Seasonality, and I finally was able to get rid of a lot of these things. We are up 58% of the time in January for a 1.1% return. Not a big edge there. But when you take November to April, this is the best performing time in the market, the best 6 months, up 7.1% and up 77% of the time, which is not 100%. And then November to January tends to do quite well here. And then we're in the first half of January, which tends to perform well. Then the second half also performs well, but not as well on a historical basis. And this is looking at the quarter. The first quarter of the first year of the presidential cycle is usually weak. Now, it still has us up 0.1%, but it's not all that strong either. Thank you. I hope you enjoyed this. I hope you found it helpful. Have a really good week, and I will talk to you in the next video.